Right now, the largest silver futures exchange in the United States has roughly 103 million ounces of silver that can actually be delivered. At the same time, there are more than 400 million ounces worth of open contracts tied to the upcoming delivery month. That imbalance only works as long as most contract holders accept cash instead of metal, and that assumption is now being tested. In just the last few weeks, close to 785,000 ounces of silver have been leaving exchange vaults every single day. Not occasionally, not during spikes, every day. If that pace continues, tens of millions of ounces will be gone before the next major delivery window even opens. The key moment arrives on February 27th. That's when holders of March contracts must declare whether they want to roll, settle in cash, or take physical delivery. On that day, paper promises collide with physical reality, and the numbers are tight. This is not just a silver investor issue. Silver is embedded in semiconductors, data centers, AI hardware, electric vehicles, solar panels, and industrial electronics. Any sustained disruption in physical supply doesn't stay isolated in the metals market. It ripples outward into technology, manufacturing, and capital investment. Most people don't realize how the silver market actually functions. The futures exchange is primarily a paper market. The majority of contracts never result in metal changing hands. They're closed out in cash. The system is built on the expectation that delivery requests will remain limited. Inventory is reported in two categories. One is silver that can be delivered immediately. The other is silver stored in the same vaults but owned by third parties and not available unless the owner chooses to make it so. Only the first category matters for settlement. The headline inventory number often includes both, but only a fraction is actually usable. That usable inventory has been shrinking for years. Since 2020, deliverable silver has dropped by roughly 70%. In January alone, nearly 50 million ounces exited exchange vaults. 2 years ago, total annual withdrawals were a fraction of that. The pace has changed dramatically. This tightening isn't limited to one exchange or one country. London inventories are near historic lows. Shanghai inventories are at their lowest levels in years. At the same time, both the United States and China have classified silver as a strategic material, making global flows more restrictive. One of the clearest signals of physical stress is the silver lease rate. This is the cost to borrow physical silver. In normal conditions, it stays below 0.5%. Recently, it surged to around 8%. That kind of spike only occurs when physical metal is hard to source and borrowers are competing for limited supply. March is especially important because it's a primary delivery month. Hundreds of millions of ounces worth of contracts are outstanding against a much smaller pool of deliverable metal. If even a modest percentage of contract holders demand physical settlement, inventory levels fall rapidly. What's driving this shift isn't retail speculation, it's professionals exploiting a price gap. Paper silver is often cheaper than physical silver in global markets. That creates an incentive to buy futures, take delivery, and secure metal faster than the open market can provide. For industrial users facing long lead times, this can be the most efficient route to supply. If delivery pressure continues, the exchange has limited options. It can force cash settlement instead of metal, it can change margin requirements or position limits, or physical and paper prices can diverge, signaling stress in the pricing mechanism. All of these outcomes have happened before. The difference now is inventory. In past silver spikes, vaults were full when rules changed. Today, they are not. Rules can be adjusted, contracts can be restructured, but physical silver cannot be created on demand. At the same time, the broader supply picture remains constrained. Silver has been in a structural supply deficit for several years, with annual shortages measured in hundreds of millions of ounces. Industrial demand continues to grow, driven by energy transition, electrification, automation, and computing infrastructure. Most silver production is a byproduct of other mining, meaning supply cannot quickly respond even if prices rise. This creates a fragile balance. Short-term volatility is likely. Rules changes are possible. Sharp pullbacks can happen, but the underlying tension between paper claims and physical availability hasn't disappeared. It has intensified. The next few weeks won't answer every question, but they will reveal how much pressure the system can absorb before it has to adjust. And markets tend to move not when problems become obvious, but when confidence quietly starts to shift.